Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard.
John, welcome back to Kaiser Watch.
Jim, pleasure to be back on the show.
John, what does the world of resource juniors look like at the start of November?
Well, Jim, I just got back the latest batch of financial data for the resource listings, the TSX Venture CSE juniors, and now everything's up to date in my database till June 30th. And it does not look particularly good in terms of the capitalization, the financial capitalization of these juniors. Of 1,175 TSX Venture listings that are in the resource sector, one group that has negative working capital owes $3 billion, and the group that has positive working capital has $5.4 billion in the treasury as of June 30th. And of course, that will be less when we finally get the September 30th financials and the ones in between later this year, because it's been a busy year for a lot of companies. And what's even worse, of the $3 billion that companies are in the hole, $2.4 billion of that is owed by companies trading below a dime. And how many are trading below a dime? Well, 555 at the end of October to be exact. 47% of the companies are trading below a dime. Another 20% are trading in the 10 to 19 cents. And, you know, we've seen this obliteration of market value this year. Almost every company has a ski slope heading downwards. And in terms of where you should be looking, you know, I'm gearing up for the whole sort of end of year bottom fishing season. 603 companies, they have positive working capital of $500,000 plus. There's a small group that has 177 that has 15 has you know, from positive $1 to up to $500,000. Those are there, but with that amount of money in the treasury, you can't get very much started. So it'll be fairly simple. I have a relatively small field of companies to go through, sift through later this month and into December to see what are going to be the bottom fish accumulation companies by the end of the year. In terms of traded value, the resource juniors continue to outtrade the non-resource listings, the cannabis, the crypto. It's still over 50%, and in the past week we've seen it get up to 70%, but not for a good reason. We're already seeing a massive capitulation. For example, one of my bottom fish, for which I've covered many years, Nevada Exploration Inc., which is using golden groundwater to search for blind lower plate altered systems, find another Carlin type system. They had that South Grass Valley project. In late August, they admitted that they didn't have money to pay the BLM for all their claims. They ended up getting a $500,000 bailout from EMX Royalty, which allowed them to make the payment. But the company has just put out a press release saying that we are going to have to do a reorganization of the company, which means a rollback. They obviously don't have any money to really continue drilling. So the stock was trading as low as a half cent the other day as people just said, okay, I'm done. I'm out of it. And so that's the sort of discovery exploration extreme. At the other end, we saw Pure Gold Mining finally admit that, yeah, we just don't have enough money to keep anything going. They filed for bankruptcy, and of course that took the stock also down to a penny with a 30 million share blowout. So this kind of capitulation washout, it has helped the resource juniors dominate in both volume and value traded on the TSX Venture Exchange. So not a particularly good situation. One of the factors I will be looking for in my bottom fish screening is a chart pattern anomaly. Not one of companies going down and bottoming, actually looking for companies that have managed to flatline throughout most of the year. And two of the companies that are currently classified as bottom fish, which have done reasonably well in terms of fundamentals, they have flatlined, and these are the kinds of stocks to look for, the ones that haven't died on the vine this year. I talked about Endurance Gold last week a fair bit, about how they've expanded the Reliance project into an entire district play, how they've announced a $1.5 million financing. They closed it very quickly and in fact sold an extra $500,000 to raise $2 million. They don't have to worry about the remaining 20 holds not having anything interesting in them, and then getting smashed into the garbage can at the end of the year, to then have to finance at rock bottom. They've got the money to resume drilling in the first quarter. I assume that, although they haven't told us anything about the visuals in the remaining 20 holes at Reliance, I'm just judging by the way they've done deals with the First Nations and acquired the extra land and got this financing done. I think that what they're seeing and have reported so far is the foundation for this thing to finally achieve liftoff. That's Endurance Gold. Another one of my bottom fish that I've sort of marveled, it's a prospect generator. It's Eagle Plains Resources. They have $10 million plus in the treasury because their Taiga paper got converted into cash when Taiga was absorbed by SSR Mining earlier this year. And they're still sort of floating along in that 15, 17 cent range. And they are trying to figure out a way to monetize their royalty package. A lot of the projects that they have, they've sold 100% to other parties, and retained a royalty, uncapped. The Banyan Resources project in the Yukon, which has a large low-grade gold resource, is one of those. So maybe if they can figure out some way of monetizing that, that would be a big plus. But also on their Vulcan project, they went in, drilled several holes with their own nickel this fall, didn't hit Sullivan 2, but found a lot of very interesting mineralization, peripheral mineralization, that's helped them put together why they think the earlier explorers probably didn't have a proper understanding of the stratigraphy. So people like myself are saying, you've got 10, 12 million bucks in the treasury. Don't punt this off to some other company. Spend at least another million, 2 million on this next year and see if you can deliver a Sullivan 2 for this Vulcan project. So these kinds of companies where although they're getting no lift from results that they're reporting, these are the ones to watch for. It's part of this whole idea of emerging discovery where things are improving, but you're not getting a market reward. This is what I'm going to be screening for, in addition to companies with money, but it's going to have to be also screening for stories. Is the story still alive? Does it still have room to grow? That's a lot tougher than just looking for money and structure and the other traditional bottom fish criteria.
Are there any positive trends in the junior resource sector?
The only really visible positive trend continues to be the lithium sector, and I've devoted a number of Kaiser Watch episodes to the Lithium Mania 2.0. And although metals have been crunched again in the past couple weeks, lithium carbonate prices, after pulling back from their $35 peak earlier this year, are almost back at $35 per pound. The supply-demand imbalance remains unresolved, and of course makes sense because you cannot quickly ramp up new supply in response to a sudden surge of battery demand from this escalating electric vehicle sector. But I'm also looking at this this question of $18 billion worth of lithium was sold last year. Even if the total volume doesn't increase, it'll have been at almost double the price. It'll be like $36 billion worth of lithium that's been sold. The projections about how much is needed by 2035 and beyond, it implies a tenfold expansion of current supply. And this realization that there's like trillion-dollar markets at stake with regard to the electric vehicle commitment that the automakers have made, that the gigafactories that are being built. The sector has gone beyond the point of no return, and the market is waking up to what is really sort of the second significant cycle. Lithium Mania 1.0 was 2015 to 17. Some of the companies that stuck it out during that period, for example, Sigma Lithium Corp, it touched a $5 billion valuation in the past week. They raised $42 million late last year, at around the $74, at around $4 level, in response to the, it was last year that people realized that the EV sector is growing and that there's going to be a lithium supply problem. So they have this in the Itinga district of Minas Gerais in Brazil. They have a collection of pegmatites that run 1% to 1.5%. There's about 50 million plus tons of that. They've done a feasibility study and are developing about a 15 million ton system at about 4,000 tons per day. That's just the beginning. At the current rock value or lithium carbonate price, we're talking $2,700 per ton rock. Now, I think in the long run, lithium carbonate goes back to $10 a pound, but you're still dealing with $900 a ton of open pitable rock. So the market is realizing that these deposits are going to have to be acquired. This company's already in the sort of construction phase, shifting from pilot plant study into construction. They did $137 million financing earlier this year at $11.75. Big entities like BlackRock came in. A company like this is very likely going to disappear, be acquired by one of these big entities that wants to have a secure supply of lithium carbonate for their battery factories. And this will be the beginning of a liquidity event. We've already had several liquidity events in the past year as other companies got bought for $500 million to $1 billion. But none of that is enough to really take care of this future demand that's going to be facing the car makers at around 2030 when the sales of these electric vehicles starts going exponential. And we can see at the other end of the spectrum, there's a little company called Tierlac Resources. They rewarded their shareholders with a 20-for-1 rollback back in 2011, and they've done they built up the issue to 63 million shares through a series of very cheap private placements and warrants. Nobody ever shows. The current management owns less than 1% of the existing stock. They've got one credible person on board, Lindsay Bottomer, who used to run the exploration division of Teck, and he owns a massive 100,000 shares in this. About a month ago, they picked up a bunch of lithium moose pasture in Ontario next to projects that other more serious companies that have that know what they're doing had picked up land. So they picked up tie-on type stuff, and then a week or so later, a couple of people joined the boards with cannabis background, no obvious background in this resource sector. And then in the past week, the stock had climbed up to 50, 60 cents based on that, even though they really had nothing in 63 million shares up. Then they announced a $5 million financing at 50 cents, 10 million units at 50 cents. And the stock is now over $2 on a fully diluted basis. It has a $163 million market cap. Management owns zero paper. It is not clear who owns this paper or why it's not being sold, given the absence of anything of fundamental value in the lithium space. These two sort of end posts of the spectrum, a very real company that has put a lot of work into advancing a pegmatite system in Brazil to be production ready and actually be a solution to the problem. To this other end, where groups are now positioning to benefit from Lithium Mania 2.0, we're not seeing the kind of trading frenzy that I would associate with a mania in full effect. But I do see all the groundwork in place, and it's this bigger picture context that by 2035, even if lithium carbonate's back to $10 a pound, that lithium will be $100 billion plus annual market. This is a staggering idea that that we haven't really experienced ever on this scale. This is something phenomenal for the juniors, and we're starting to see this week, Brunswick started perking up. The other secret one that my subscribers have been accumulating is perking up. So the lithium sector, in particular the pegmatite hunters in places outside of Australia where they are also waking up after getting bashed back earlier this year, this is the one sector in the resource juniors that I see flourishing, even if we go to hell in a handbasket with higher interest rates and a tanking gold price and base metal prices sagging because of the expected deep recession that Powell's interest rate inflation fighting campaign is going to create.
John, is the perpetual permitting cycle of Perpetua Gold Corp potentially coming to an end? Seems like they're named aptly, Perpetual and Perpetua.
I'm not sure why they chose that name, Perpetua, because this has been an eternal permitting cycle. Now, they filed, or at least the U.S. Forest Service Department released a draft environmental impact statement in August 2020, shortly after which the company then published a feasibility study that reflected the primary scenario. That had a lengthy comment period, as a result of which they filed a modification of this. And then John Paulson, the biggest shareholder, had some sort of hissy fit and fired Steve Quinn and his Canadian team and made it all a local event, and then carried on with the permitting. And so here we are almost 2 years later, and on October 28th, the U.S. Forest Service finally released what they call a supplementary draft EIS. It kicks off a 75-day comment period that ends on January 10th next year. And they accepted the modifications that the company had submitted. It took them almost 2 years to figure this out. There is, of course, the local opposition from the tourist industry, which thinks some catastrophe will happen and ruin the tourist industry. But we are now where we thought we were 2 years ago in late 2020. If this ends up, if a final decision is made, it'll still take another year before they can do anything, because then there's like 50 other little sub-permits that they need to take care of. So we're still at least a year away from getting a construction decision, a green light for a construction decision, but it may be a Pyrrhic victory. The feasibility study used a $1,600 base case price, and I've created a sensitivity model for this where I use their ore schedule, all their assumptions, and at $1,600, it was about an $800 million NPV using 10% and 1.2 billion at 5%, and the capex was about 1.3 billion, so that was close, and the IRR was of 28%. So it met or was very close to all the hurdles. And of course, when gold went to $2,000, this was well in the money, which is why I've had Perpetua Gold Corp as a KRO favorite for several years. But in the meantime, we have had inflation, and we also don't quite know what the costs of all the modifications are. So what I have done is I've done what I did with the PEA of FDX nickel for the Baptiste, which was released around the same time in 2020, and just done a brutal cost escalation across the board, increased capex, sustaining capital, OPEX, all 20%, and then just run the entire model as it is. And the outcome is not good. At the base case price, we have a range of $400 million to $700 million after-tax NPV, which is well below the new $1.5 to $6 billion capex. In fact, we need to go all the way up to over $2,000 for the 5% discount rate NPV to reach $1.6 billion. So the price of all this heel dragging is to effectively make the stibnite gold antimony project probably not viable at today's prices. If they use Forest Service suddenly said, oh, yeah, we want you to build this, we want the jobs and all that, I'm not sure the capital markets are going to give it to them. So it's a depressing situation. They will have to redo the feasibility study and tell us what it actually costs. And that may be a very unpleasant surprise because they have not been able to contain the inflation rates. And gold, was down sharply Wednesday when the Federal Reserve raised the interest rates another 0.75%. And the general feeling is, we're heading into a recession. The big markets, the Dow, it had been up sort of in the past week and a half. It had a bad day on Wednesday. We'll see where this goes. But anyways, it's going to be, even if it isn't a perpetual permitting cycle anymore, it may be a dead end for the project.
John, your 2022 Kaiser Research Favorites Index finished October down about 25%, but that is up from being down 39% in mid-October. Is the worst over for your Kaiser Research Favorites?
Well, I think most of them are either close to the bottom or have already bounced off the bottom. For example, I talked about FPX nickel last week, which has been under selling pressure from what appears to be an institution that got in early 2021, and that now appears to be finally gone. But the ones like Galway Metals, which have ounces in the ground, couple million ounces, and building more, they continue to suffer from the lower grinding gold price. P2 Gold is, also they just announced a financing which the insiders are going to participate in. They're both linked to copper and gold, and Northwest Copper is also linked to copper and gold. And Perpetual Gold, it'll be a while before we find out how much more expensive putting stibnite in production has become over the last couple of years. And with gold, there's always the possibility that gold may zoom upwards in a big way that outpaces inflation, so that it's not just an inflation adjuster. And Verde Agritech, it had a good week. It managed to get over $7 after announcing that they had finished commissioning also the phase 2 of Plant 2, so they're now fully set up. If the world wants K Forte in 2023, they're going to be able to produce it and deliver it. So that company, I think, is in excellent shape. The Brazil election was very close, 51 to 49%. Lula won. There's some concern about what sort of policies he will invoke. Jair Bolsonaro so far has not attempted to cause a Capital 6 type revolution and create a coup and make Brazil back a dictatorship. So everybody's kind of like in a frozen mode, wondering, okay, is this going to all normalize and life go on? But the one that gives me the heartburn that I worry about is SK Mining Company. It has the SK Creek project up in the Golden Triangle. On October 7th, they announced they had completed 29,500 meters from a program that began in late May. They have not reported any assays. The work has been focused on two areas, the TV Jeff area that got them excited at the end of 2020 and on which they drilled a lot in 2021, but couldn't put anything together that showed any meaningful tonnage and grade combination. But this year the focus also shifted to a target John DeDecker had worked hard with his crew to develop. It's the Scarlet Ridge area, which is in the northern part of the property to the southeast of the original SK Creek 1 mine. And they've done a lot of drilling. They've reported seeing sulfides, but no assays. You can't tell if you have gold. And the reason I'm worried about this one is this one was priced for an SK Creek 2 type of outcome. I've done a visualization of what an SK Creek found today would end up being worth, and with the same mining rate, the same resource, 43 gram per ton gold, 2.5 million tons, 2,200 gram per ton silver, that would end up being worth about 3.7 billion Canadian, which would translate with the current fully diluted to a future $18 stock price. But we needed that equivalent of a whole 109 to signal game on. SK Creek 2 is on the line. Let's get into total S-curve territory. We've been in partial S-curve territory for this outcome, but now with the season coming to an end and no work likely to resume until June of next year, this is one where if the assay results don't please the market, and right now this market is hard to please with anything, this is one which could undergo another 80% plus drop between now and the end of the year. So this one worries me a lot. The context of what they've got, it leaves it open that they could pull a rabbit out of the hat. But there is another sort of problem hanging over that project, and it's the fact that as of the end of August, they only had $5.4 million in working capital, and I'm sure they've spent a chunk of that. All the warrants that they have are now out of the money. The lowest batch was about 1.6 million at $1.30. That expires in early December. I'm not sure if they'll have what it takes to get those exercised, but even that's just a drop in the bucket of what they may need to finish paying for this year's program. And certainly during that sort of 5-6 month lull while they wait for the next season to resume, they're going to be in a very tough spot raising money. And this market right now, I mentioned earlier, what sector am I keen about? Well, really only the lithium sector, because if this economy grinds into a recession and at the same time inflation rates persist and they keep jamming it higher, gold is not going to create any joy for this sector. So most of the rest, I'm pretty happy with. Yeah, some of them may go a little lower. I see them as good bottom fishing targets, but SK Mining was still a $250 million valuation at its $1.25 price. That still has a lot of downward room to drop if the market loses the faith that they are on the edge of making an SK Creek 2 discovery.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser. I'm Jim Goddard.
Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.